We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Don Durrett, author of How to Invest in Gold and Silver, investor and contributor to Seeking Alpha, as well as the founder of goldstockdata.com. How are you today, Don?
Hey, Tom. Thanks for having me back.
Excellent to have you. So you were warning that gold wasn't breaking out like we typically see back in January. So has this year progressed the way that you expected it would after the slow start that we had?
Yeah, it's pretty much gone exactly as I anticipated. So back in January, I thought that gold would break out based on kind of the uncertainty of the Democrats in control around the economy. And I thought that gold would have a good January. I thought it might, run, if you will. And it didn't. And I said, uh-oh, we're in big trouble here. So in November and December and January, all three of those months, the stock market went up. So I was like, oh no, this is bad for gold. So the stock market is basically trending. Everybody's comfortable with Biden. Nobody seems to be nervous about COVID damaging the economy. And so we're going to need an event to basically get gold running here again. And the only thing I really worry about, or only thing I really care about, is a new all-time high in gold. And I'm not a trader. I don't care about gold going from 1,800 to 1,900. I want gold to break out. I want it to go above the old all-time high, which is 2,075. Mm-hmm. So that's my focus is on how do we get above 1950 gold. So back in January, I was like, how do we do that? So the only thing that really resonated with me, the number one, the highest possible outcome to get gold over 1950 is for the risk on trade to flip to a risk off trade. I wrote about that in my February newsletter. I talked about gold being trapped and that we have to wait for the risk on trade to flip. And so we're still there. So some people think that gold can break out above 1950 just on a melt up. So everything goes higher. S&P goes to 5,000, inflation goes to 6-7%, and gold follows them up. But I'm not in that camp. I hope that's what happens. I don't really want my scenario to unfold. I just think it has the highest probability. So my scenario is that in order for the risk on trade to end, you have to have a correction in the stock market. So I think that's coming. I think it's coming it could happen in September. So let me talk about that a little bit, about the timing of when this risk on trade ends. So I thought once we got through January, February, I thought that March was safe because Biden hadn't given a State of the Union address yet. So everybody's kind of in a wait mode. So I thought March was kind of a safe month. So I thought April was the earliest we could correct. And April and May, and we didn't correct in April and May, and stock market just kept going higher. So then we got to June. I thought, no, we're not going to correct in June or July, and then probably not in August. So all summer long, I was saying, just hold on. We're just going to keep trending through the summer. And then we get to September, October, and then that's when it gets dicey. So now we're kind of in the dicey season where the correction could happen. And so the key here is if the correction gets bought. So let's say the stock market goes down 5%. Does it get bought or does it keep trending down more, 6, 7, 8, 9, 10%? We're going to have to wait and see if it gets bought or not. And I've looked at all the factors, and I think right now it's like 50-50. I mean, nobody really knows if this correction is going to get bought. Some people say we're not even going to get a correction. We're just going to keep flying. We're just going to keep going and going. But historically, it's rare to go a full year without a 5% correction. They just don't happen that often. In this economy, I don't think it's really strong enough to really support this. I think the economy is weaker now than when we went into COVID. It doesn't really deserve this huge stock market rally that we've had. So I see a correction coming. I think it could happen as early as September, but will it get bought or not? So Jeremy Grantham is one guy I really pay attention to, and he recently gave a podcast interview a couple weeks ago. And he said that this is the biggest overvalued market that he's ever experienced, and that it's going to correct very soon. And he said it could last a few more months because it could overgo. And he's thinking maybe first quarter of next year was as far as it could go, but it could correct at any time. And I'm with him. I'm with Grantham. I think that we're going to correct sometime between now and say the end of the first quarter. And when that correction happens, my feeling is it won't get bought and we'll start muddling and the stock market will kind of get stuck here. And I think some bad things are going to happen. And that's when the risk on trade, I think, flips. And I think that's when gold gets a bounce and goes higher. And so the one thing here, so I'm saying, it's first down and then up. And so down, my targets are 1550 to 1650 gold. And I think when the correction happens, we'll go down to 1700 as far, very quickly. To be at 1700 is you snap of the fingers. And once we're down at 1700, then, we're basically 1600 is coming to play. So I think we trend down to 1650. I'm hoping 1650 holds, but I don't really think it will. And then it'll go lower. I think there's a chance we go into the 1500. So if that happens, you're going to get a significant correction in the miners. And so if gold's going to go down, silver's going to follow it as well. So you're going to get sell-offs in both. And then we have to wait and see when it gets a bid. When does gold get a bid and after the market corrects? Will it take a week? Will it take a month? Will it take 2 months? We don't know that. It's all up to the Fed and the markets. But it's all about uncertainty. Once the uncertainty kicks into gear, that's when people are going to buy gold. And when I say people, I'm talking about the big money people, not the retail crowd.
So is part of your, let's say, reason for the crash just that we haven't had this 5% correction this year yet? Or is there other factors kind of leading into why you see a correction for the general equities coming?
Well, the main reason is what you just said. It's just overdue. It's just unusual to go that long without a correction. They tend to happen. Mm-hmm. That's just how the market kind of works. You just kind of get these cycles. But if we look at the factors that come into play here, and everything is kind of broken. I mean, we have the Fed funds rate is 0.08. I mean, it's almost at zero. And so we have this free money and all the way up, the 10 years at 1.3. So all these bonds are basically, you're losing money. Anybody that's buying bonds is losing money, which is really strange. And they don't want, and so they have to pay. We're in, everything's kind of weird right now. I mean, MMT didn't even exist, 20 years ago. And now with MMT, modern monetary theory, they talk about debt as not really mattering. The only thing that really matters, debt's just a number. The only thing that really matters is the ability to create liquidity. So whenever you get a problem, you just inject. You just keep expanding the money supply. That's the new theory. Well, that's the idea that you can print prosperity. And I just don't think that's possible. So we have this really crazy economic strategy policies going on right now that create this underlying tension, if you will, that we cannot allow a recession. We cannot allow a correction because everything's going to start kind of spinning out of control. The banks right now will not loan money to each other. What's that about? Instead of loaning money to each other, what they're doing is they're loaning money overnight to the Fed in the tune of $1 trillion, called a reverse repo. I mean, we've never seen this before. It's just we have a lot of strangeness going on, a lot of tension, and a lot of uncertainty. And there's no reason to really be real bullish at this point in time. For people to be bullish just because the stock market is trending. Remember I mentioned Grantham saying this is the most overvalued market he's ever witnessed. He's been in these markets since the 60s. So I think the 60s, but definitely the 70s. So we have this situation where it's really difficult to be, it's getting difficult to be bullish that we're not going to have a correction. Now, you can be bullish that the correction is going to get bought. I get that, because the reason why it will get bought is because people see it as an opportunity. You know, the Fed's just going to keep things going. They're going to keep injecting, just buy the dip, buy the dip, buy the dip. So I get that. But definitely the uncertainty with COVID, for instance, COVID is now going to last to 2022. I think we're all aware of that. It's not going away here in Q3, Q4. It's going to linger into 2022. So that means that the economy is going to continue to be weak. And the one thing we know about the economy is that it's so broken at the moment that we really don't even pay attention to the numbers, right? We don't pay attention to the GDP. We don't pay attention to the jobs. We don't pay attention to the PMIs. Whatever they come out, we just kind of nod, okay, that's what they are. But we don't put a lot of value in them because of COVID. COVID has kind of disrupted everything. And that disruption is apparent. And I really think that's the reason why we haven't had a correction for so long, is everybody's kind of in this wait and see mode. And so the wait and see mode is just keep doing what we're doing. You know, August was a really good example of that. I mean, it was just so flat. I mean, the markets kept trending to all-time highs. But I mean, if you look at the dollar, you know, 92 is basically 92 the whole month, right? 10-year, you know, 1.2 to 1.4, somewhere like that. You know, everything, the 10-year, the DXY, the HUI. The HUI had a little bit of volatility, but right now it's at 250. 250 is kind of where it started. So this month was really kind of let's just wait, you know, the summer doldrums. But I think September is I think we're going to see some excitement here. And I really think we're going to see a lot of excitement in Q4. A lot of volatility. Gold could go all the way down to, the HUI could go all the way down to 200, and it could end the year over 300. That's the kind of volatility we could see in Q4. It could get really crazy.
So you mentioned let's say the disconnect between the market and the economy. And I wanted to get your thoughts around if that disconnect, the actual economy versus, you know, seeing the stock market flying, if that has now if this disconnect has been evident now more than ever.
Yeah, I think so. I think it is more apparent to people than ever before. You know, it's very apparent to Grantham, for instance. You know, Grantham is basically saying there's a huge disconnect here, people. And he's never, I've mentioned his name at least 3 times. Mm-hmm. The reason why is because this guy has never been wrong on a market change. Whenever there's been a market either go up or a market go down, he's always basically been there, done that, nailed it. And so when Grantham is saying this is the most overvalued market, something's going to give, you gotta respect what he's saying. But then if you start connecting the dots, we haven't had inflation at this level since the 1970s, early 1980s. Most people that are investing have never invested in a market that's had high inflation. And the Fed keeps saying that it's transitory, but how long is it going to last? When does the inflation go away? We have steel prices right now that are tripled what they were before pre-COVID, tripled, 300% higher. We have shipping rates that are at all-time highs. These shipping rates are going to move, those are going to basically be pushed over it to consumers. So we're seeing food prices that are going higher, restaurant prices going higher. We have rents. Rents are going, we've never seen rents go this high. Housing is higher now than in 2007 than it's been. So inflation is basically not a positive thing for the economy. Inflation is negative. So so all of these factors are showing the disconnect, showing why this is probably not a time to be 100% in the stock market. I mean, yeah, maybe we do, go higher. Maybe the stock market goes from 35,000 to 38, 40,000. I mean, that's a possibility, but we are at some point it's going to correct. You can always wait and get back in by the bottom, but it's definitely a time to be defensive because everything kind of points to that. I've said that I think that the economy is not going to go back to normal. So what is normal? Normal was actually a fairly weak economy back in March 2020. When I say fairly weak, if it wasn't for the Fed, we probably would have had a recession sometime between 2009, 2020. We didn't have a recession because the Fed adopted MMT and basically injected money whenever the stock market fell. It basically refused to allow a recession. Janet Yellen actually said, we're not going to have a recession, any more recessions. We have MMT now. We can just keep injecting money. We don't have to have recessions. The Achilles heel for MMT is inflation, and inflation is here. So that has to basically make people a little bit nervous, I would think. I saw yesterday where a billionaire, Mark Mobius, said to put 10% of your assets into gold. 10%. I mean, that's a lot of money into gold. And a lot of people have, fairly large portfolios. I mean, that's a bunch of money, he's basically saying. So that shows, his concern. And when I said, we're not going back to normal, so what is the new normal going to be? I think that by even saying a sentence like that, it implies an uncertainty. What is the new normal? Well, that's uncertainty. We don't know what it is. I mean, it's possible that the new normal is basically a very weak economy where, I remember back in 1990, 91, when we had that last serious recession. I mean, 2009 recession, it only lasted about, 6 months, and we started growing. In June of 2009, we were already out of it. But back in 1991, when we had the dot-com crash, 99 is when we basically had a recession. We had a recession in 99, the dot-com recession, and then in 2000, 2001, it kind of hit us again. I don't think people realized how many jobs were lost. I was in Colorado at the time, and there was 100,000 IT jobs lost. It was impossible to find a job. If you got laid off and you were an IT worker and you lived in Colorado, you couldn't find a job. They were getting 100 resumes per position. That was a weak economy. Well, I'm saying that could happen again where you can't find a job. Right now, everybody seems to be bullish. There's a lot of IT jobs out there. You can find work in IT. This isn't, a serious recession, but if the numbers kind of unfold like they seem to be pointing to, and let's say that the corporations start laying people off, the whole job market thing could flip and get nasty. We could go back to the malaise of the late 70s where you have high inflation and very low job growth. That type of a scenario is not, crazy talk. That's a possibility. So I think that gold and silver here are actually positioned very, very well. All we need is this risk off trade to kick into gear and the big money to basically realize that they need to hedge uncertainty. And if they hedge uncertainty, gold's going to start trending higher. And once it gets over 1950, it's like, Katie bar the door because it's going to start trending.
So, Don, as you're talking about the risks coming into the last, let's say, third of this year, the last quarter, how likely do you see it would be for Biden to start raising taxes? And are there any other policy changes that could have a real effect on the markets here?
So first of all, they've already raised the corporate tax rate. All they need to do now is go through the motions, but it's basically all signed, sealed, and delivered. So the corporate tax rate's going up. So the thing that really shocked me was that they did not raise the capital gains tax for people under $1 million. That shocked me. I thought for sure they were going to raise it to 25% for all of us. And they didn't. They just raised it on more than $1 million. But if you make in a single year, if you have more than $1 million in capital gains, you got to pay 42% or something, 43%. You get nailed if you have big gains. But I think up to $1 million, I think it's low. I don't think it goes to 40% until you're over $1 million. I'm not sure on that. So So the average investor, under $1 million in capital gains really didn't get hit, and income tax didn't go up. It only went up for people over $400,000. And the big one here is the corporate tax. So the corporate tax went up significantly. And they actually also closed a couple loopholes for corporations. So they're going after business. So Biden is not, and I've said this, he's the very first anti-business president that we've had. Period. I mean, if you go back, there hasn't been a president who there hasn't been, for instance, we have not raised the corporate tax rate since the 1930s. Since the 1930s, the corporate tax rate was never increased until now, starting next year. So presidents basically never never attacked corporations. You had Obama talk about it, but he never did anything. If you look at Obama and you look at Clinton, Clinton was basically a moderate. And then you have to go, all the Republicans are definitely pro-business. And then if you go back to Carter, and then you can go back to Johnson and definitely Kennedy in the 60s, none of those presidents were anti-business. They weren't. They were basically pro-business presidents. They did what businesses needed. You never had a president that basically came out, attacking a business, attacking a corporation, doing something negative towards them. Biden's the first one. He basically kind of has a war on the oil companies right now. He basically cut off drilling on federal land. He basically is, I think, one of those projects was fairly big in Alaska. So he's not a business-friendly president. He went after corporate tax. He's basically been going after. He cut off the pipeline, which was almost finished. It didn't have a lot to go, and he stopped it. I mean, that was really an anti-business move. So those are the policies that are going to kind of hurt us over the next 3 years. Is that it's going to be difficult for Biden to change his stripes. So let's say that next year, if we go into recession, is he going to suddenly get religion and be pro-business? It's not going to be easy for him to change his stripes in that regard. I think he will let the Fed try to basically manage business. So the policies are net negative at the moment. They appear to be net negative for the next 3 years for business. On top of that, it's interesting to see what he's doing with regard to, say, globalism. So another one that he did was he increased the taxes on corporations bringing their money back to the U.S. Do you remember that? It was a world global tax on corporations, kind of a minimum tax thing. Ireland's pushing back at the moment. That hasn't passed yet. But he was for that. As a matter of fact, Janet Yellen was the instigator of that. So you have that tightens the kind of the noose, and not the noose, but it tightens the screws around the economy as far as corporate profitability globally. So you have that going on as well, which kind of slows things down, which is not good for the economy. And my point is that the economy and gold are kind of at opposite ends. Mm-hmm. If the economy is doing well, then you don't need gold. You can hold it as an asset, but you're holding it against uncertainty. It was Bernanke says the only reason why you hold gold is to protect yourself against really, really bad things, right? So if the economy's doing well, I don't need any gold, I'm fine. I'd much rather be invested in something that's going to go up in value, that I am confident it's going to go up in value, Even if it's a bond that's only returning 3%, at least I'm getting 3%. Right? So people don't want to hold a lot of gold. So if the economy is doing well, then you're not. The only reason you're really going to get really excited about gold is if it has a lot of good, fundamentals behind it. And I think right now the economy is showing that it's in a cycle that points to a lot of uncertainty. And I think that gold could really have a big move here, depending on how the economy unfolds, both in the US and globally over the next 2 years. But I think that if gold gets to 1950, I think we could easily run to 2,500 or higher over the next 2 years, which would be a pretty significant move.
Absolutely. But I'd like to turn on from, let's say, this uncertainty to something you've talked about before, and you called it the buy of the century situation. So what asset class does this apply to, and what should we be paying attention to as a result?
Yeah, so the buy of the century is actually silver miners. Now, the gold miners, the gold producers, and even the developers in the exploration story have the upside potential to be, very, very significant. I'll start with gold, and then I'll talk about the kind of the investment of the century generation. So let's say gold goes to 2,500. The cash flow on those companies, their cost won't go up depending on inflation and depending on energy costs, of course. But by and large, their free cash flow is going to really increase significantly. That's going to have at least a twofold positive impact on them. One, it's basically going to give them higher free cash flow. So the higher free cash flow is going to get valued higher. So let's say a company is currently valued at 10 times free cash flow. Every dollar of additional free cash flow they get, it increases in value. But the twofold part of this, the second part of this, is that their balance sheet improves. So their balance sheet improves because all of that free cash flow, they're going to get rid of a lot of debt, or they're going to have a lot of cash on their balance sheet. So the balance sheet's going to improve, which is going to lower their risk. By lowering the risk, they're going to get a higher multiple. So we're going to see multiples potentially double. Probably not double, but close to it, depending on what kind of a mania you get. So you get almost a doubling effect here. So you get the increase in value on cash flow, and you get the increase in value on the higher multiples. So even if you're a gold producer, let's take the most, and you get more return depending on how much leverage. So like the juniors probably could be 10x, the mid-tiers 5x, the majors 2x, 3x, depending on how high gold goes. So let's say $2,500 gold. A company like Kirkland Lake currently has about $900 million in free cash flow, and they're valued at about 12 times. So their free cash flow is going to increase, go to $2,500 gold. It's going to go up to, 1.3, 1.4 billion. It's about, 25% or higher increase in value, maybe at 25, 50. And then their multiple is probably going to jump from 12 to 20 or 25. Remember, I said doubling. So you have this doubling effect of value just on the multiple. Now, Kirkland Lake has no debt, and they have at least $700 million in cash, and they're generating $900 million in cash. So a company like that, their multiple is going to, and if gold keeps going $21, $22, $23, $2,400, their multiple is going to start going up. So you see this two types leverage. They're going to go up on the multiple. They're going to go up on the free cash flow. So a company like Kirkland Lake is going to basically just going to be flying. Now, Kirkland Lake's valued at $10 billion. So they're just one example. But a company that's valued at, say, $1 billion and has the same type of, leverage, they're going to go up even faster. And if it's 100 million, they're going to go up even faster. So the leverage, even on the gold miners, is pretty significant. I mean, we're looking at some really solid returns. Three baggers is nothing really. When you look at, if we go to $2,500 gold, three baggers would be a dime a dozen. There's only 86 miners that are mid-tiers and majors, 86, that's it. So if you eliminate half of them for location risk or bad balance sheets or bad properties or bad management, you're left with about 40, 45 producers that are quality. Those 40, 45 are going to average somewhere around 3x or higher. That's what you're looking at. So what industry has those kind of returns? hardly any, right? As an overall in sector, right? Okay, that's gold. And now let's double that because silver has twice the leverage. So this is your investment of this century. Twice the leverage. I just told you about a scenario where the average is 3x. So with silver miners, you're talking 5x, 6x average if silver goes to $100. Now, people always tell me, Don, $100. What are you smoking? It's not going to $100. Well, so if you look at the silver chart, silver has only made 2 runs to $50 ever. And both times it only stayed at $50 for less than a month, and then it crashed. It was 1980 and 2011. Those are the only 2 times. Silver's only been over $35 in its history for a very short period of time. So there's very little resistance once you get over $35 silver. On top of that, if you look at the money supply since those 2 occasions, especially in 1980, when it was at 49, you look at how much the money supply has increased since 1980, and then how much has increased since 2011. I mean, they increased the money supply 40%. 40% in the last 2 years. So the money supply has been going crazy. And before 9/11 hit, the Fed had less than $1 trillion on their balance sheet. Today it's $8 trillion. They added $7 trillion, and all that money, none of it really went into silver. So you have this huge money supply explosion. And remember, I said it only went up twice to 49, and both times it crashed back down fairly quickly. So you have no support above 35, very little. So if silver gets the last run that it made last year from July till August, in 1 month, silver went from $18.50 to $29.50. That's a big move. $18.50 to $29.50. I don't know the math, but it's over 50% because 50% of 19 is 850s. That's 27. So it went up over 50% in 1 month. So going up, silver has that kind of radical leverage where it can just really move very fast. Plus, on top of that, investors historically, say from 2000 until now, have only bought about 20% of silver, of the supply, the annual supply. So the annual supply is about 1 billion ounces. And only about 200 million of those go to investors, about 20%. The rest go to fabricators. Silver is used in everything. Anything electronic has silver in it. So, all your phones, all your cars, all your computers, all your appliances, they all have silver in it. So 800 million, 80%. Last year, over 50% of the supply was bought by investors. Most of it went into ETFs. 50% of the supply, 500 million ounces, went to investors last year. So where did that other 300 million come from? It came from the inventory. Well, they're above ground inventory. Well, there's not a lot of above inventory left. This year, investors are going to buy somewhere between 30 and 40% of the inventory. We're running out. The above ground inventory is running out. The fabricators want 70, 80%. So right now we are already in a contest. I don't know if contest is the right word, but we are in a kind of like a demand competition between investors and fabricators over supply. And if investors keep wanting 35, 40% of the silver supply, they want 350 to 400 million ounces of silver, we're going to run out very quickly of above ground supply, and we're going to have a shortage. I've been saying since I wrote my book in 2010, 2011, that we will see silver shortages during the next bull market. So once silver goes over 30, and again, all it has to do is get above 28.50. If it gets above 28.50, the technicals say that it'll trend to 30. Once it gets to 30, it'll be off to the races. Last time it took 1 month to go from 18.50 to 28.50. This time I think it's going to take 3 months to go from 30 to 50. 3 months. Can you believe that? So if silver goes from 30 to 50, what do you think the miners are going to do, the silver miners? They're going to go berserk. Berserk, that's the word to use. They're going to go nuts. So basically you have a 2x. They're going to go. When silver goes to 30 to 50, it's going to be outperforming gold on a 2-to-1 basis. Mm-hmm. That's my point. So the GSR is going to shrink from right now. It's around 77, 78, somewhere in there, maybe 75. I haven't looked at it recently. It's going to go down to 40. The GSR is going to shrink in half. That's what it did in 2011. No reason why it won't do it again. It went to 39 in 2011. Here's one it'll spin your noodle a little bit. Guess what silver did in 1980? The GSR went to 18, 19. It went under 20. So if the GSR goes under 20 this time, which isn't crazy talk, that would be 3x leverage. So you got 3x leverage on your silver miners. That's insane. Gold miners are going to average 3x. If we get a 3x multiple, the silver miners are going to go up 9x. That's the possibility here. So that means that's your investment of a century. Now, it might not happen. You know, people have done, you're nuts. We're never going to see $50 silver in our lifetime. It's never going to happen. Well, we've seen 49 twice, and the money supplies went nuts. And once you get over 50, the last time in 2011, I don't think silver stayed above 49 for a week. I think it went to 49. A week later, it was at 47. A week after that, it was at 44. I think 2 weeks, it was gone. This time, what's going to happen is we're going to go through 50 like butter and go straight to 65. That's what I think is going to happen. We'll go straight to 65 just on the technicals alone. Once you hit an all-time high above 50, you're going to springboard. And I think it goes to 65 and then it sells off and it goes back probably down in the 40s. But you're going to get that initial run, I think, and then it's going to take off again, I think, and that's when it's going to basically start trending to 100. I think it's going to take a while to get to 100, 2 years, but that initial run to 65 will probably take 3 months, which will be pretty weird. I mean, it's going to blow our minds. And then, you know, you want to be selling from 50 to 65, you're going to be taking profits. I'll be taking profits at 50. I'll be taking profits at 55, 60, 65. I'll take it all the way until it corrects. Every $5, I'll probably take something off because I've basically been doing this since 2004, and I haven't really sold. So this is going to be my opportunity to kind of get out, and I'll be selling all the way up to 100. By the time we get to 100, I'll be selling 75% of my miners. Keep the last 25 from 100 to 150. That's the plan. Sell the silver miners first, sell the gold miners second. Because I think that gold is probably going to have a pretty strong bull market here. Once silver, if silver goes to 100, I think it'll take 2 years to happen. Mm-hmm. Gold will go to 3,000. So I don't think we hit 3,000 gold for 2 years. And when we hit 3,000 gold in 2 years, I think the GSR will be 30. I don't think it'll be 20, but even at 30, that's over a 2x leverage. So there's your investment in the universe. So I said there's 86 majors or mid-tier producers. I don't know how many of those are silver, but it's probably 20, something like that, maybe more, right around 20. And so I tweeted 18 silver stocks, and 20 gold stocks. So those 38, if you hold those 38, I mean, my goodness, the return should be pretty significant. Mm-hmm. So thanks for asking that question, by the way.
Absolutely. I in doing some research for today, I came across that and I just couldn't resist getting your thoughts on it. But I want to go through a little bit of your thinking around how you go about finding the exploration or development plays that you would be willing to put money into. I know you've said in the past that there's a real outsized ratio of uninvestable companies in this space. So how do you go about separating the wheat from the chaff?
Yeah, this is a tough question. I'll try to answer it as quick as I can. It's very complex. I mean, it takes years to really understand exactly how to filter these stocks out and identify, which ones do you buy, which ones do you don't. For me, and I have a book that people can read. They go to my website, Gold Stock Data. On the main menu, it says book. You can go over to Amazon and get it. And it has a lot of, I have seven, I've updated it 7 times, 7 editions, maybe 8 editions. I think it's 8. So I keep it up to date. And that's in that book, the last chapter, I basically talk about how to value a mining stock. And what you do is you look for red flags. That's what you start at. And then you compare those red flags to what I do. I use a future valuation. So the red flags, the first thing that I look at is the properties. So I look at the properties and I look for, I want to find something that has significant future cash flow. I want to make sure they have the goods. I don't really want to take outsized risks that they don't have quality properties. So properties are really important. I like to look for flagships. So for me, I'm looking for 2 million ounces of gold or more, because that's going to give significant free cash flow. But I will go down all the way to 1 million based on their exploration potential and also their valuation. There's some small producers like Fiore that I think only has 1 million ounces, but they're producing great. Impact Silver. There's some small producers I'll do, but they're rare. I focus more on 2 million ounces or better kind of expectations, or they already have the goods. So properties are important, with the location of the property, the grade is always really important. The IRR, if they're a developer, I look for 25% or higher post-tax. If I'm going below the IRR, then it's an optionality play. Now I'm just spouting out here some stuff here. There's a lot goes into it, but I'm going to keep going here. Just keep talking about value, how these value. So look at the properties. Then I go to the people. The people, have they done this before? Are they good executors? And you get tricked a lot of times on the people, especially on your exploration and development plays. A lot of these exploration plays, they really don't care too much about investors. They let the investors pay for the drilling, but they basically end up selling these things, and you get a small premium, and it doesn't work out that well. And the same with the dev stories. The shareholders end up paying for the development, and then they sell, and you get a small premium. You don't get that. They never make it to first pour, or the companies that find a discovery, they don't hold out for, the best gains they possibly can, or they don't take it. So it takes a lot of experience to you really shouldn't mess around too much with exploration and dev stories. For the first 2 years, you really should focus on high quality producers. Learn it, especially the first year. You're just going to make mistakes. You're not going to really understand the industry. It takes a while. So I talked about the people. Have they done it before? Then I look at the balance sheet. Balance sheet's important. A lot of it is like how much money it's going to take. So the balance sheet is different types. So if it's a producer, I don't like I like companies that are cash focused. Some companies, they don't care about holding debt. They'll hold $1 trillion or $500 billion of debt, and they just hold it forever. They never get rid of it. They pay a little down, they add it back up. I don't like that. I like companies that are more focused on cash. Because if companies have a lot of cash, they're going to pay it back in dividends, or they're going to grow. So I like companies that are cash focused on the producer side of things. And the other thing I don't like people to do is to do a lot of dilution. So companies every single year buying more shares, that shows you they don't really care too much about investors. They just want to grow the company. And a lot of it is for them. They build these companies that gives them security, job security. Instead of taking risks. I like I like aggressive companies. Companies that are growing. I Am Gold is getting punished for being an aggressive company, but they're super cheap right now. Fortuna just bought a company in West Africa. They're getting, punished. But I like those companies. They're aggressive. Equinox Gold, they're buying companies. I like that. I like companies that are aggressive, or they're finding ways to grow free cash flow. So balance sheet and then aggressiveness, that those come into play. I guess I'll end it there. There's lots of different topics. Again, in my book, chapter 9, it basically goes through everything that you look for, red flags. So the final thing that I do is, after I identify all the red flags, then I look at the upside potential of the company. If is a company, let's say that it's a drill, let's start the drill story. So if it's a drill story, is it early on in the drill story? How much bigger is it going to get? How much exploration potential is it going to get? I like to get in before 100 million because if it's a good drill story, it could get to 2, 3, 4, 500 million. And again, you want to make sure that they have a good discovery hole. So if you have a company that has a couple of really good discovery holes and it's under 100 million, it's in a good location, then that drill story might make sense. You're still speculating, you're still taking risks. But I like the discovery holes. I actually have a YouTube video and tells you how to identify good discovery holes. Then on development stories, as far as valuation goes, I look at the IRR, of course, and then the NPV is important. And then you compare that to their current market cap. I don't really like to see, and then the other thing you look at is the CapEx. You compare, again, it takes a long time to kind of understand all this stuff. Mm-hmm. So I don't like the CapEx to be close to the NPV. I like the CapEx to be, a lot lower than the NPV, sometimes 5 times lower. So I don't like to see these big CapEx, anything that's over $200 million CapEx, I start to get nervous. I like to see kind of entry-level projects and they can grow, but I'll go a little bit higher, but the sweet spot for me would be like a CapEx of 150 million, NPV of like 400, 500 million. Those kind of look sweet on valuation basis. And then you have to look at, what's the future cash flow? And then what I do is I take the future cash flow and I estimate out what their future costs are and then what their future valuation is going to be. I estimate a future market cap, and I show you how to do that in my book. And then I compare that to their current market cap. And if it's not at least 500%, I usually am not that interested on a development story. Mm-hmm. So in a development story, I really it really has to be over 500% to get my interest, because they're going to dilute shares to build that project. So ideally, I want it to be like 1,000% early. And then I like to see the first pour within 3 years. If it's a development project and they're going to do first pour within 3 years, then it starts to get more interesting. And once you go beyond 4 years, the risk really starts to increase because of all the dilution. So you got to be careful on these development stories. I say that you only make money on 20% of your development stories, and you only make money on 20% of your exploration stories, even if you know what you're doing.
Yeah, it's a really complicated thing to learn to analyze, as you point out, Don. But I want to just touch on something that you mentioned there. And when we think about location of a great project, so do you start to look around other projects in the same geographical location, taking into consideration that it's best to find gold where it has already been found?
Well, it's better to, yes, it's always better to find a development project, even a drill story project that's nearby an existing mine. Mm-hmm. That lowers the risk. It makes it easier to permit. It makes it easier for the infrastructure because we already see somebody mining there. So mining districts really help the location tremendously. If you have a project that's out in a location that nobody else is mined around, then you're on your own. ATAC Resources basically tried to get a road to one of their projects, and they got denied. And this was in the Yukon. It's like, what's going on? They got denied the road. They couldn't even get a permit to build the road. So that's a bit of a mess. So if you're out there all by yourself trying to do things, permitting can be a problem. Yeah, that's the other thing. See, there's a lot of unknowns with locations with permitting. Some places, some countries, you think you're okay because, we've never heard of like location issues. But believe it or not, if you're trying to build a mine where there isn't any other mines in the area, you never know what kind of permitting issues can pop up. Mm-hmm. It happens a lot. You think, oh, you're fine, but so it's always ideal, if you will, to find these development projects that are in a district, in another area where they're already mining. Mm-hmm. So you have to be somewhat leery of a project that's basically all by itself on its own, because they got to build the infrastructure on their own, which costs more money. Plus, the permitting is never a guarantee. Plus, sometimes the permitting gets delayed or it takes longer. When you're permitting somewhere that's never had a mine before, they tend to look at it a little closer, a little finer tooth comb kind of thing. Mm-hmm. So that, yes, you got to be very careful on the location. And then also the countries. I've been burned many times on countries. I stay away from certain countries now. So you have to decide which countries you're comfortable in and which ones you're not in. I firmly believe that Australia and Canada are the safest countries. And I think that those countries, you want to own as many mid-tier producers and majors in those countries as you can, There isn't usually majors global, but there's a lot of mid-tier producers in those. I try to own as many as I can, but you have to get a good entry price. The reason why is because I think these companies are going to get valued at a premium. I haven't heard anybody else talk about this, but I think it's going to get really strange. I think you're going to see companies in Canada that are valued at crazy multiples, 30, 35 times free cash flow, just because they're in Canada. Maybe I'm wrong, but that's my expectation.
Interesting. That's like you say, I haven't heard anybody talk about that before either. Don, I want to ask you one more question before we wrap up here. What's the difference between your buy the dip list and your watch list, and what is the purpose of each of them?
Yeah. So back in January, when I realized that gold was stuck, I said, well, we're going to get a correction. So if we're going to get a correction, that's when you want to get ready to buy the dip. So I started telling people in my newsletters to start creating your own buy the dip list. So there's a lot of stocks that you'll look at and you won't buy them because they're too pricey. You'll go, there's not enough alpha there. There's not enough upside. I'm not going to buy that stock. Well, put it on your buy the dip list. Maybe you'll get lucky. Maybe it'll drop down into your buy area. So that's what I've done. I've created a buy the dip list. I actually bought 2 stocks yesterday. So we're starting to get this correction. We're at 250 on the HUI. So I'm not 100% sure that gold isn't going to get a bid, and gold could basically take off tomorrow, right? Nobody's 100% certain. So I looked at my buy the dip list. It was the end of August. And I decided I wanted to go on my account to see if I owned any miners that were in this new issue with OTC, because OTC basically is there's this new rule that's going into effect. It's supposed to go into effect in August, but they moved it out 30 days. Now it's going into effect in September. And what that ruling is that some of these stocks you will not be able to buy anymore on OTC. You can't buy them anymore. All you can do is sell them. So I decided to go online to see if I had any, and I didn't. But while I was online, I checked any of the stocks that were on my buy the dip list that were currently cheap. But I thought, okay, this is a good entry level. I don't care if they get cheaper. They might get cheaper, but okay, I'm going to go ahead. And so I bought 2 stocks. So I'll go ahead and tell you the 2 that I bought and the reason I bought them. The first one I bought was Anaconda Mining. Now, Anaconda Mining, I got it at 62 cents. And I thought, it's printing as a 6-bagger at $2,500 gold. And it's in Newfoundland. And I really want more exposure to Newfoundland. I own Marathon and Maritime and Newfound Gold. But I like Newfoundland. I think Newfoundland's going to be a gold district, and I think it's going to be a big story. So I wanted more exposure, and I said, okay, I'm going to go ahead and buy Anaconda at 62 cents. It was on my buy the dip list. I could have waited, and I probably would have got it for 50 cents or somewhere between 50 and 55 if I would have waited for the dip. Who knows? Maybe it'll go lower than that. I put it on your buy the dip list. But I think Anaconda is a pretty solid company. I like their management team. I like their location. I like their upside. They don't have a lot of red flags. Everything looks really positive. The only red flag is their resources, which are low, but they're having some really good drill results. So not a lot of red flags with Anaconda, I don't think. Everything looks pretty rosy. So I bought it. The other one I bought was one of those hold your nose, go for the moon stocks, which is Hycroft Mining. Hycroft Mining has basically, they went bankrupt as Allied Nevada, and then they renamed themselves. But they didn't produce, they basically went bankrupt, and now they're coming back. But they're having trouble with some of their metallurgy and some of their recovery rates and their costs, and the price crashed. So it's down to $200 million, $200 million market cap. But they got everything in place to totally explode in value. I have them projected as a 40-bagger, but that's without dilution because they probably will dilute. But I have them as a 40-bagger at $100 silver, $2,500 gold. Well, it's in Nevada, which is not a bad place to own, not a bad location. They have a new CEO who I think knows what they're doing. I think their CEO is going to figure this out. The other thing I liked about it was it's an optionality play. So yeah, it's a total dog at 22 or 23, $25, $24 silver. It's a dog. Nobody wants to own it. But at $35 silver, starts to change. If we get and I think that the bottom after this next run comes, I think the floor in silver is going to be $40 silver. So if the floor is $40 silver, this stock looks good. It's a spec stock. I called it a dog, but I don't mind going after these high risk, high reward stocks if I think there's a shot there. So I think there's a shot there. I don't mind taking it. It's like throwing a dart, but they could easily be a 10 plus bagger, 20 plus bagger if gold and silver take off here, because price fixes everything basically in mining when you're a producer. So I decided to take a shot, but I still have about 10, 6, 4, at least 10 stocks still on my buy the dip list. So I'm waiting for the correction on the rest of them. Now the watch list are stocks that I'm watching to potentially buy if something happens. So I'm looking for triggers. So first of all, so there are some on my watch list that conceivably could be on my buy list, but my buy list is pretty much full. So I don't want to really add to it. So there's a couple on there that probably will roll up into so I have a buy the dip list now, but it's usually called a buy list. So the buy list are stocks that I want to buy now. Either I don't have money in my account at the moment, or I'm waiting for an event. I'm waiting for something, but they're basically ready. They're ready to be bought. And so there's a lot of stocks on my watch list that they just need events to happen for me to de-risk them. There's a couple that are development stories that need permitting. I'm waiting for them to get their permits. I'm waiting for them to get financing. I'm waiting for them to release something, a PEA, a feasibility study. So there's events. I'm just waiting on an event. And once the event happens, then they might roll up. Now, it's really smart to have these watch list, because the watch list, if you analyze a stock and it has 10 bagger potential, but it has this really ugly red flag, don't just ignore it. Put it on the watch list. Maybe the red flag goes away. Mm-hmm. And that's something that I've learned over time, is that these things switch. I've been doing this since 2004. You'd be amazed on how many stocks that I have said, I don't want to buy it, and changed my mind and bought it really, really cheap. We're human nature. And basically what we do is, when we think bad about something, we don't flip our mind. Our mind is bad. I'm never going to buy it. Bad, bad, bad. An example is I'll give you one example that basically people can relate to. So Alexco Resources, they have a really ugly streaming deal with Wheaton. It's nasty. It's 25% of their production, or 20% of the production Wheaton gets for a fixed price. So basically they're producing 25% at a loss because they don't get enough money back to cover their cost. So I basically said, I'm not touching this thing with a 10-foot pole. I don't like that. I don't like that streaming deal. At the time when I rejected it, they were basically over $3, I think. This is a while ago. And it kept going down, it just kept going down. I looked at it. No, I'm not touching that thing. I mean, this thing was not on my watch list. Never got there. It should have been there. That's my point. It should have been on my watch list, because there are not any big silver producers in Canada. There just isn't any. They're the only one. So I'm not touching that thing. I'd analyze it every year, and I didn't even think about buying it. It was at, it went under $1. I still hated it. Went to 80 cents. I hate you. I'm not touching you. 60 cents. I still hate you. 50 cents. I hate you. Went under 30 cents. I said, okay, I'm in love. I'll buy you. And that's what you have to do. If you hate a stock, put it on your watch list and put a little note why you hate it. Because these things, sometimes these stocks go all the way down. Another one that I hated or I ignored was Lakeshore. And it was trading over $3. It went all the way under 30 cents too. Some of these stocks just crash and burn, but the potential is still there. The risk reward is still there. And so you put them on your watch list and you put the nasty thing that you don't like about them and you wait. And so that's what I'm doing. There's one called Kingston Resources that looks like just a massive potential, but it's got an ugly red flag on it. I'm waiting. Another one is City Gold. Is another one these stocks have just crazy upside potential, but they got to resolve their issue. And if they resolve their issue, then you can jump on them. So that was a long answer, but that's it.
It's excellent, Don. That's I really appreciate you sharing a lot of your wisdom and thoughts with us here today. You've certainly created an excellent resource over there at Gold Stock Data because you've done this and looked at so many of these different equities, right?
Yeah.
Of course, thanks. You're available at Don Durrett on Twitter and at goldstockdata.com. Anywhere else you'd like to point to?
Yeah, follow me on Twitter. I started working full-time on Gold Stock Data about a year and a half ago. And since then, I've been on Twitter. So I'm on Twitter every day. And I usually tweet, one or two somethings every, so it's good to follow me. If you're not going to join Gold Stock Data, it's $149 a year. If you're not going to join that, then you can follow me for free on Twitter. So
you've also got some excellent articles over on Seeking Alpha too.
Yeah, I post usually there once every 2 months about.
Perfect. All right, Don, thanks so much for your time today.
Thanks, Tom. I appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.